The Intelligent Investor is a The Intelligent Investor is a book that explains not how to make money, but how to protect it. According to Benjamin Graham, the main purpose of investing is not to chase high returns, but to grow capital over the long term by protecting it from permanent losses. For this reason, the difference between investing and speculation is frequently emphasized throughout the book. According to Graham, an investment is an action made through detailed analysis, containing a margin of safety and prioritizing the protection of principal. Anything that does not meet these criteria is speculation. In other words, purchases made with the hope that prices will rise are not investments, but predictions. Graham states that the intelligent investor does not try to beat the market, but instead focuses on controlling their own behavior. According to him, the investor's greatest enemy is not the market, but their own emotions. Fear, greed, impatience, and herd psychology are the sources of the biggest mistakes investors make. The intelligent investor does not respond emotionally to market movements. They evaluate price fluctuations not as a threat, but as an opportunity. Graham uses the Mr. Market metaphor to explain this idea. Mr. Market is like an unstable partner who knocks on investors' doors every day and wants to buy or sell his shares at sometimes very high and sometimes very low prices. However, the intelligent investor does not get caught up in Mr. Market's mood. When prices rise excessively, they do not buy. If prices fall well below their true value, they see this as an opportunity. The market's role is not to guide the investor, but to serve them. Graham divides investors into two groups: defensive investors and enterprising investors. A defensive investor is someone who does not want to constantly follow the market, prefers to take less risk, and aims to move forward without making mistakes. For these investors, broad-based funds, strong and large companies, and long-term investments are recommended. An enterprising investor, on the other hand, is someone who spends more time and effort, analyzes financial statements, and looks for undervalued companies. However, Graham says that most people think they are enterprising investors, while in reality, they should be defensive investors. The most important concept of the book is the margin of safety. A margin of safety means purchasing an asset at a price significantly below its true value. This margin serves as a buffer against analytical errors, economic fluctuations, and unexpected crises. According to Graham, the intelligent investor should first think about how much they can lose, not how much they can gain. If there is no margin of safety in an investment, no matter how attractive it may seem, it is risky. In stock selection, Graham focuses on financial realities rather than popularity and expectations. Companies that have been profitable for many years, have low debt ratios, pay stable dividends, and are priced reasonably are valuable to him. Stocks inflated by excessive growth promises, widely talked about, and whose prices have soared due to expectations, are generally dangerous. According to Graham, an investor should not look for a good company, but for a company bought at the right price. Balance in portfolio management is very important to Graham. He does not consider it right for an investor to put all their money into a single asset class. He recommends establishing a balance between stocks and fixed-income investments according to market conditions. This balance makes emotional decision-making more difficult and provides protection against sudden market movements. The goal is not to achieve the highest return, but to follow a sustainable path. Inflation also holds an important place in the book. Graham says that an investor who does not protect the value of their money actually becomes poorer without realizing it. Cash loses purchasing power in the long term. However, this does not justify investors taking unconscious risks. According to Graham, the biggest mistake is making wrong investments out of fear of inflation. Not taking risks is also a risk, but taking uncontrolled risks is a much greater danger. Graham is very clear about market bubbles and crises. Throughout history, in every major bubble, people have said, "This time is different." In periods of excessive optimism, prices detach from real values, while in periods of extreme fear, Even valuable assets become cheap. The intelligent investor tries to understand these cycles and learns to act opposite to the crowd. They buy when people are afraid and sell when people are overly enthusiastic. This is the main reason Warren Buffett was influenced by this book. Buffett says that investing is not a game of intelligence, but a test of character. Patience, discipline, and long-term thinking are at the center of Graham's teachings. The intelligent investor does not give investors guaranteed profit formulas. It gives them the right way of thinking. In conclusion, the intelligent investor teaches not how the market works, but how the investor should think. The main message of this book is this: intelligent investing is not about buying the right asset at the right time, but about learning not to do the wrong things at the wrong time. In the long run, the winners are not the smartest ones, but the most patient ones.